Next, let's have a look at a simple economic model of a market for loanable funds. Conceptually, any market consists of the demand side and the supply side. So let's start with the demand side. Consider this chart in front of you. On the horizontal axis, we have the amount of loanable funds that exchange hands on the market for these loanable funds. And on the vertical axis, we have the price, the cost of those funds, the real interest rate. Demand for loanable funds is basically the relationship between the real interest rate and the quantity of funds demanded. This relationship is negative. Higher real interest rates would reduce investments, and if the firms don't invest as much, they don't need as much funds, so the quantity of loanable funds demanded reduces. Lower interest rates would make the cost of investments cheaper, that would increase investments, and it would increase the quantity of loanable funds demanded. So the changes in real interest rates lead to a movement along the demand for loanable funds. Another factor that would affect the demand for funds is expected profits. If expected profits change, then this whole curve, the demand for funds, would shift. Greater expected profits would make investments more attractive. A lot of firms would want to make those investments, so they would require more funds. They would demand more funds at whatever rate they can get them. So at all these different rates, the whole demand curve would shift to the right with greater expected profits. And on the other hand, deterioration of expected profits, possibly because of a recession, would mean that companies don't want to make any investments. If they're not going to make investments, they don't need to borrow the funds, and the demand for loanable funds, this whole curve, shifts to the left. Moving to the supply of funds, the supply of funds is also the relationship between the real interest rate and the quantity of loanable funds supplied in this case. The quantity of loanable funds supplied depends on the real interest rates, on the disposable income, that's the income after tax, expected future income, wealth, and default risks. Starting with the real interest rates, higher interest rates would make savings more attractive, as the savers would receive greater rewards for savings. Higher savings means a greater quantity of loanable funds supplied. Reduced interest rates would make savings less attractive. Savings would reduce, and the quantity of loanable funds supplied would reduce as well. So we have a positive relationship between the real interest rates and the quantity of loanable funds supplied. And a change in real interest rates would lead to a movement along this supply curve. A change in disposable income would move the whole curve, or would shift the whole curve to the right if disposable income increases, and vice versa. A decrease in expected future income would shift the whole supply curve to the right as well, as in expectation of lower future incomes, people would start saving more now, and vice versa would be the case as well. A decrease in wealth also shifts the supply curve to the right, as people generally try to regain the levels of wealth they used to have. And lower default risks would also shift the supply curve to the right. Having learned about the demand and supply of loanable funds, finally let's combine demand and supply together to find our first market equilibrium. Let's say we have demand for funds given with this straight line, this demand curve, where interest rates are equal to 20% minus 0.002 times the quantity of funds demanded. And the supply of funds is given by this equation where the interest rates are 0.02, that is 2%, plus 0.005 times the quantity of funds supplied. To find the market equilibrium, what we have to do is just solve these two equations as a system of equations, finding the real interest rate and the amount of funds that would satisfy both equations. I can solve this by equating the right-hand sides of each of the equations. That would give me 0.2 or 20% minus 0.002 times f equals 0.02 or 2% plus 0.005 times f. That means 7 1,000ths times f equals 0.18 or 18%. Solve for f from there, giving us 25.7. Whatever it is, let's say it's in millions of dollars exchanging hands on the loanable funds market. Knowing f, we can find the real interest rates from either of these two equations. I'm going to use the demand equation. Just substitute this number for f. That would give me this equation and the real interest rate of around 14.9%. So these 2 points give us a market equilibrium. Next, for a quick review of real versus nominal interest rates, consider the following example. If real interest rate is 14.9% or 0.149, and let's say inflation is equal to 2.1% or 0.021, how much of a nominal interest rate would that imply? We've previously mentioned that real interest rate is equal to the difference between nominal interest rate and inflation. Simply rearrange that for nominal interest rate. That would give you a nominal interest rate as a sum of real interest rate and inflation. 14.9 plus 2.1 equals 17%.